In 2012, the troubles of the Eurozone sent the currency area back into recession and weighed on sentiment in the rest of the world, including the neighbouring emerging markets. What will 2013 bring? To answer this, in the studio with me is Simon Quijano-Evans, who is EMEA Chief Economist at ING. Simon, thank you very much for coming in.
Thank you.
Well, 2012 was a difficult, dramatic year for the Eurozone. Let's go through some of the past couple of years. These are the bond spreads of the main countries in the Eurozone over German bond spreads. And as we know, they spiked in 2011, early 2012, and then started to come down with the new ECB interventions. This, however, wasn't enough to bring the Eurozone back to strong growth. So if we can see the growth rates for the Eurozone, we see, of course, a recession at the financial crisis, then a rebound in 2010, but then everything started to slow down and we had a recession in the Eurozone as a whole towards the end of the year. Now, what should we expect in the year coming forward?
Martin, we have to start becoming more positive. There's been too much pessimism around the last few years. Obviously, this is dependent on what the Eurozone politicians have been doing. Now we have got the message from Eurozone politicians that they want to move ahead. We are in the next stage of EU convergence, of Eurozone convergence, with Eastern European countries having joined several years ago and looking for something to converge on.
So you're saying that we should finally believe the politicians. They always say we have a solution, but now they actually do.
Well, as your spread graph showed, markets do believe in the politicians and do believe that the Eurozone is going to stay together. If you had shown a chart of euro-dollar volatility as well, there you can see we are at pre-2009, 2008 levels now in euro-dollar volatility. So it shows that markets are believing in the Eurozone as a goal, basically, and something staying together.
So there won't be a protracted recession, in your view? We'll come back to growth?
I mean, you see it very clearly. 2010, as you said, was a pickup. Obviously, because you had very low base effects. We've had a change in countries like Germany to just-in-time production, so less reliance on stock building, big amount of stocks being built up, as we see here in 2008, 2007. So there's been a big change and a structural change, which is very positive as well.
So we'll see, hopefully, those structural changes coming through. Now, what about the rest of the world, in particular the emerging markets around Europe, which you study? They did quite well during the crisis, but still, Eurozone problems, it really has weighed on everyone's confidence.
Well, the thing is that one positive in emerging markets is that debt to GDP levels, public sector debt to GDP levels, are much lower than in G7 countries.
Right.
So this is something that's going to be able to drive growth for the next few years. The second thing is that everywhere we have to start looking at consumer confidence. And consumer confidence is very much dependent on what media gets fed by politicians and the media news wires out there. So as long as media wires are looking more positive this year in 2013, which I would expect, then we start to see consumer confidence picking up. There's no way that governments in G7 can go on a spending spree. That's finished. Yes. So it really is a consumer that has to pick up now.
So let's talk a little bit more about the debt background first. You're saying these countries have lower debt to GDP ratios, and we're talking about Eastern Europe and Turkey and so on here, I assume. So in a sense, is it fair to say that they benefited from the problems in the Eurozone because investors could see, well, here are some countries that we thought were basket cases, but they're actually much more solid in their fundamentals?
Well, what we've seen is a natural development over the last 4 or 5 years. Before the crisis came in 2008 and 2009, everybody was telling emerging market countries, get your debt down. While Eurozone countries were building up debt in their local currency, in the euro, without any limit. The limit for the other countries was they had to, if they wanted to borrow in a foreign currency, they had to go into the exchange rate risk.
Right.
Now, the situation where we have now, and if I'd shown you a chart with CDS versus ratings of Standard & Poor's and Moody's, for example, then you see a clear structural move. Eurozone, bottom left-hand corner, so AAA, all the way down to sub-investment grade in many countries. And this is something that's going to continue simply because debt dynamics in emerging markets are much better than they are in developed markets. But under the underlying fundamentals in G7 countries, we have to see them start improving, and I think that we're going to start to see that.
Simon, thank you very much. So, good news has already worked for the emerging countries. It may start working for the Eurozone. Thank you very much for watching Author's Note.